Welcome to the CFA Society India podcast, where society members engage in conversations with industry experts to bring you unique insights. This podcast represents the views and opinions of the originally featured speaker and is posted with their express consent. The podcast is meant for educational purposes only. It should not be construed as research, recommendation, solicitation, or investment advice by CFA Society India. Now, let's dive into today's episode.
Hello, everyone. Welcome to the CFA Society India podcast. My name is Jolly Balva, and I'm the host for today's episode. I also host my podcast called Investing and Purpose. At the risk of being trite, when China sneezes, the world catches cold. We witness something to that effect these days. The property market debt crisis has certainly taken a toll on the economy. But apart from that, there are also some long-term structural changes that are at play. In today's episode, we will have a closer look at what's panning out in China's economy and markets. Joining me today is Herald Van Der Linde from Hong Kong. Herald is an author of the book Asia Stock Markets from the Ground Up. The book talks about unique features of each Asian stock market and what drives the different sectors in these markets. Herald has spent nearly 30 years in the world of Asian investments and is currently heading equity strategy for Asia Pacific. So there's a lot to unpack today. Welcome, Herald. It's a pleasure to have you.
Well, thanks for having me on, Jolly. Glad to be here.
All right. So, Herald, if we could first talk about the property market woes, like the entire sector has been in crisis for around 4 years now, and multiple developers have defaulted on their payments, especially the offshore ones. Even Country Garden, which is like the biggest developer, has also defaulted lately. So there has been a sector-wide liquidity crunch as well. And now there are also rumors of bank runs happening. So how does this situation look to you?
So China's growth model is changing. And in the past, China's growth model was really focused on infrastructure. That means not only property, but also subways and railways and roads and bridges and all these things were built. And investments therefore led the economy. They would like to change that now because they found out that actually they've built quite a lot already, and the marginal benefit for an additional investment is coming down quite rapidly. And this is most visible in property. We've had a lot of residential development, of course, in China. In some places too much, in other places it's okay. In addition to that, there's been all sorts of other, kind of other investments of infrastructure, subways and railways and these sort of things in cities, or maybe a concert hall or maybe a soccer stadium, very often financed by local governments. And the problem now is that on the local government side, we see that debt is running up. They've been trying to sell land, but that demand is coming down simply because in a lot of places we've overbuilt. China has overbuilt. Now, that means that prices are coming down, and this is a problem if you're a developer with a lot of debt on your balance sheet. You can't sell your product, or at least you can't generate the revenue and cash flow that you require in order to sustain, have cash flows in order to repay that debt. And that's where we are at the moment. And a couple of things now need to happen. First of all, we need, basically, prices are coming down in order to clear the market. There's too much development taking place. And for a lot of the developers, it doesn't make sense now to go and build something because you hardly make money on it, right? So you get supply consolidation. There's not a lot of property being built anymore. And over time, hopefully, if demand continues to grow, as the economy continues to grow, demand will catch up with supply in that sense. Secondly, you need to restructure the debt, not only of the developers that are struggling, but also with the local governments that have too much debt on their balance sheets because they build these concert halls or bridges and rails and roadways and don't reap the benefits from it and can't sell the land in order to get there. And that's where we are at the moment. So what does that mean over the next couple of years? It probably means that prices and this market is not going anywhere, but that we're going to get gradual consolidation on the supply side, that a lot of these developers throw in their heads says, I can't go on anymore. Some of them will close. Some of them won't grow, and other ones that are in a slightly better position and can still grow because they're in the right positions, they can probably take over other companies and gain market share. And that will be a very slow process that might take, who knows, 5, 6, 7 years to unfold.
Okay. So, do you still think that a systemic fallout can be avoided?
Yes, I think a systemic void that can be avoided. The major problem here is the debt that the local governments have. That is, if you look at the numbers, that just balloons everything. In US dollar terms, we're talking about 7 trillion US dollars in total debt. Now they have debt is a problem, but if you can service the debt, you don't really have a problem. So you have to look at the debt servicing capabilities. That's maybe say roughly 1 trillion or so. Now, these local governments can sell some assets. They can help the banks to restructure some of the loans, but they also probably need support from the central government in order to get through this. And if you put all these numbers a bit together, it looks like they will be able to deal with this. So there's not an imminent crisis that all of it falls apart. It just means they have to restructure a lot of debt over the next couple of years. And we've seen that now. We've seen some of these developers being forced to restructure their debt and lengthen it. And that means that the banks or some of the investors will have to take the pain on that, right? You don't get the money back as you initially anticipated it to be. But if you put that all together, it looks like they can work through this. Yes.
Okay, okay. And China has taken a lot of measures to kind of inject liquidity, and they've lowered key rates, and
Mm.
they're trying to boost the economy in general. So, is it helping to revive the economic conditions? If you look at outside this property sector as well, like, are there any encouraging signs from, say, a credit impulse perspective, from the
Mm.
consumer's perspective? What is your sense of that?
Yeah. So let's take first a step back, right? As a policymaker, you have a weak domestic economy and you have a property sector that is clearly going through some turmoil, and that is not a driver of growth anymore. And there's effectively only about 4 ways you can deal with it. First of all, you can find other sectors that will take over that lead of growth. But the problem is that the sectors that they're looking at, which is high-end tech or food and renewables, they are growing, but they're a small part of the economy, so they can't really take over the property sector because that's such a large part of the economy. So that is not an option they can go for. A second option is that you say, okay, what we do is we're going to really focus on trade and export our way out. Many countries have done this in the past, but given where we are in the state of the world and people were actually trying to trade and invest less in China, but moving towards other countries, like, for example, tech companies are moving to India, that is not necessarily a very good option either, although China is still showing, of course, export growth. But that in itself won't be enough. But then you can say, well, the government needs to come in and just stimulate the economy. But the problem, as I mentioned, all these local governments have issues, and they will eventually come to the central government and say, you need to help me out. So they can't just spend all their money now, knowing that maybe over the next couple of years, they have to spend money making sure that some of these local governments continue to go on. So that is not a good option either. So you have to go for the fourth option, and that's monetary policy. You need to lower interest rates and make sure that liquidity in the system is really good, and then try to get confidence back. And that's exactly what they're doing now, right? Gradually, interest rates are being lowered. They're trying to make it easier for people to get mortgages. All sorts of restrictions are being changed. And every time you do that, you tweak, and then you see what the response is. And if it's not enough, you tweak again, and you see what the response is. You could say, well, why let's not lower interest rates aggressively and just pump the economy full with money and revive it. They don't need to do that, because although the headlines look bad, the overall economy is still chugging along close to 5% at the moment. The latest data show 4.9% GDP growth in what was in the second quarter of the year. So they don't need to be too aggressive. They can tweak it here and there and see what the response is.
Interesting. So this is again, like, they are trying to target for a 5% GDP growth, but on the other hand, like, the fixed asset investment is falling, and if it continues to fall, then that level of growth may become difficult to achieve as well, right? Like,
yeah, and I think what you just said, they're targeting 5% growth. I think they would like for it, but I think what they've also done is to move away from these hard growth numbers. They understand that these growth numbers come down. If you look at the state of growth, where and the state of the economy, say GDP per capita at the moment of China, yeah, it should grow slower than India, because India's GDP per capita is lower, and India can catch up in all sorts of things, and that's exactly what's happening, right? India is growing faster. But then you say, okay, how fast were these economies growing, like South Korea, Taiwan, or Japan, that were at a similar stage of where China is now, but maybe 10, 20, 15, 20 years ago? And if you look at that, actually, they were growing at very similar rates as China now. So part of what we see in China, the declining growth rates in China, is actually a very natural response to the growing and the development of the economy that it's going through. And it needs to digest this. It needs to understand that, hey, it's natural for these growth rates to come down. This is the way we go. And within that, they try to rebalance themselves as well. So I don't think they have really hard targets as they used to have in the past.
Right, right. And even the consumer spending, like if you look at the property market problems, most of Chinese people have majority of their investments in property sector, if I understand it rightly.
Yeah.
Right? That must have kind of impacted the consumer spending, and they might more be into a saving mode right now, right?
Absolutely. If you buy property and the property goes up and you make money, paper money, you feel good about it. And it's, of course, the other way around if it goes down, and you become more careful, right? So what we see in China is that the precautionary savings, which are already high in China, have gone up further higher. And that's not just because of the property sector being weak, but also, for example, in COVID, there were no handouts like we've seen in the US and other countries. So these people didn't have the benefits that other consumers or households had around the rest of the world. For example, we in Hong Kong here, we literally got cash payments in a wallet, and an urgency. You can only spend this in a particular period in time, so you needed to spend it, right? So that's how you stimulate that. That has not happened in China, and it makes these people a little bit more cautious as well.
Indeed. So it will take probably at least 1 or 2 quarters for us to have a better sense of the short-term implications of what is happening right now.
Correct.
So looking at the slightly longer term, Herald, now there is a growing acknowledgement that the economic slowdown is rather structural than cyclical. So, I mean, you kind of alluded to it earlier as well, that they are kind of shifting the investments more into, and they're trying to focus other exports and things like that. If you could talk a little bit about these structural factors which are changing in more detail, like in China, like what?
Yeah. And a footnote with that as well. So first of all, China said, listen, the growth, you could broadly speak, in the last 30 years, 25 years, China's had three growth models. The first growth model was an export model. That was in the early 2000s. They entered the WTO. People set up factories. They exported stuff out from footwear to textiles and these sort of things, right? That was, say, broadly speaking, for the first 10 years or so, right? First decade. Then, as that meant that people got richer, people got jobs, a domestic economy was starting to evolve, and these people want to invest in, for example, property. They want to have a better house and these sort of things. So cities started to grow, and the governments, as we've mentioned, they started investing in bridges, roads, subways, etc., parks, concert halls, whatever. So these cities grow, and things got better in that sense. Now there's a realization that this has also come to an end. So the question then is, what sort of growth areas should we pick as Chinese policymakers for maybe, say, the next decade or so? And China has really taken a sort of geopolitical approach to this. It says, well, there's certain areas where we want to be self-sufficient. That's high-end tech, that is food, and that is renewables, energy, because they're reliant on global supply, and that they would like to diminish that. So that's where the growth focus is. That's where they want to spend their money. But as I said, yeah, that is, as a proportion of the overall economy, not so big, and therefore you get a situation whereby your growth rates come down, and that is the structural decline that you're talking about. But the footnote to this is that this is all important, but as the title of my book says, Asia Stock Markets from the Ground Up, you have to also look from the economy from the ground up. What do these companies do? Because in equities, we invest in companies, and the picture can be very different there. So we need to take that a little bit into consideration. But yeah, there's a structural decline. There's a reset in the growth parameters in China. That means simply lower economic growth rates. That's just the reality you have to deal with. And that means monetary stimulus, amongst others, in order to soften that. Yeah.
Indeed. And even the demography is kind of changing quite a bit. Like the 20% of the population is above 60. So they'll be trying to kind of make policies around that as well to
That is right. And so this is maybe an interesting thing whereby we can pick up how this impacts, for example, companies, and look at it from the ground up. So you're right. A lot of people are older, and generally we think, or in newspapers very often, older people is not good. People think that it's weaker growth. And that is to a certain extent correct. If you have more older people than younger people actually work and are employed, and older people over 65, say roughly speaking, not. then you can say your labor force is shrinking. Now, I think in China will be different for two reasons. First of all, what we've seen in Japan, in Korea, and Taiwan, people work longer until the 70s, and the labor force is therefore not shrinking. So I think it's an overstatement that older and aging means slower growth in China. The second thing is that older people tend to be more wealthier than younger people. They've saved money, and saving rates are high. So you get a wealth effect. There's a lot of local money available for investments. We've seen this in Japan, for example, as well. So that could be positive as well. So what they need to do is to put policies in place that benefit from that allow people to work longer, but also policies that make sure that all these people that are so big in precautionary savings, that these savings are being captured by the banking system, by the insurance companies, etc., or mutual funds, and then being channeled back into the economy, into productive investments. And that is the challenge that they need to set up to make sure that something like that happens. In certain countries, they put a government pension fund in place. In other countries, they do insurance companies that do this. In India, you have these sort of systemic saving plans, SBIs, that allow people to put money into the stock market. You can do that. In China, they need to build on this as well in order to make sure that, these savings are being channeled. In that sense, aging doesn't necessarily have to be positive. And this could be good for insurance companies and banks. Also, older people consume different. So companies can look at what these people want to buy and focus on that and less on younger people. Yeah.
Interesting. Okay, so now you have mentioned about these sectors that they are now kind of trying to focus on, and which again cannot be a complete replacement. But if you look at the, especially the green products, China has been quite aggressive on the sustainability front, and they've been kind of leading the green products exports as well, like electric vehicles, and so which are these like sectors which you think that globally are likely to do much well, coming from China.
Yeah, that's right. So again, we take a step back. There are certain areas where China is heavily reliant on the rest of the world, and that's something they want to diminish. One of them is fuel. For the size of the country, China just doesn't have a lot of oil and gas. It has some, but not a hell of a lot. So it needs to import that, and that either comes now through Pakistan that get pipelines, or through Myanmar that's got pipelines, or they ship it. This is most what it is. It's shipped through the Malacca Strait, through the South China Sea into China. That is a strategic vulnerability that they do not like in a world of growing antagonism between China and the US. Yeah, the US could easily cut off supply of that, for example, by putting a couple of ships in the South China Sea or the Malacca Strait, for example. And then, so that's a vulnerability they don't like. So you want to reduce on that. So how do you do that? Well, first of all, you try to reduce spending on fuel. And electric vehicles is a great example of that, right? So you really provide subsidies so that people buy electric vehicles, and you make sure that companies, there's a regulatory framework that infrastructure is being put in place. And at the moment, a little bit more than 1 out of 3 cars sold in China is an electric vehicle, and that will go to 1 out of 2 cars quite soon in the next couple of years. So that's happening. Now then you can say, well, that's nice, and an electric vehicle uses electricity, but it could still be from a coal mine, from oil, so it doesn't reduce your dependency. So you need to build out solar and wind and nuclear and hydro. And that's exactly what they're trying to do, to build up these domestic sources and putting a framework in place whereby it's easy for companies to invest in that. And that's why they've been quite successful, for example, in solar panels, the biggest supplier now around the planet.
Yes, indeed. And even on the auto sector front, they have kind of taken over Japan as the leading exporter as well. And
absolutely. I was in India a couple of maybe 2 months ago, so on a holiday in Tamil Nadu. Oh, wow. And I went to Madurai and then all the way up to Chennai. Fantastic trip. I like seeing temples and these sort of things. But I was also in Bangalore to see some of my colleagues there. In Bangalore, I come out of the airport, I see a Chinese EV showroom. Wow. I was in Madurai, and in Chennai, I saw advertisements for Chinese EV companies. Wow. I was in Mumbai as well. So they're penetrating Europe. They're penetrating, of course, in China big, but they're exporting really around the world. And India is a market that they're going for as well. Yeah.
Wow, interesting. This is news to me. I will check this out.
Yeah, that's right. Yeah. So okay. Some of the leaders are there in India. Small, but coming.
Very aggressive indeed. In fact, they are even giving competition to the US EV players as well, right? Like. Yeah.
Absolutely. So you have some of the leading US companies, right? They're very aggressive in China already. But you see that people in China are really going for the domestic market. Now, the problem is in China that everybody has moved. So I think there's like 80 companies that make over 400 models in China. And don't hold my feet against the fire on the numbers, but it's basically too many companies. So you need to see consolidation. And what a lot of them, of course, do is say, okay, there's a couple of leaders that will lead the Chinese market. Maybe we should be early and try to sell into Southeast Asia or Latin America or India and these sort of things. But to be honest, the leading Chinese companies, they are moving there as well. That's what I mentioned in places like Bangalore and Mumbai. There are showrooms being set up and they're trying to sell in those markets.
Wow. Okay, so Harold, now if we could put a bit of spotlight on the geopolitics part, like let's say the Belt and Road Initiative, for instance, China has been trying to diversify its export and import markets through this initiative, and they are kind of trying to move to other alternatives to the West and their allies. So if you could talk a bit about that.
Yeah. So that's right. So there's been a couple of initiatives, but the Belt and Road is an important initiative. What exactly the area is that falls under it is a bit vague, but it doesn't matter too much. There are certain countries and areas that have been identified that would be Belt and Road projects and therefore can get kind of funding from a bank that they've set up. And China would like to facilitate and be active in these markets. We've seen, for example, in Indonesia, the first high-speed train in Southeast Asia has commenced operations, I think about 2 weeks ago, between Jakarta and Bandung. They've had all sorts of projects in Italy and Greece and in I think there was something even in Venezuela, Tajikistan, and these places. So all sorts of projects that have been built out, and I think it's China's way of trying to say, okay, we got a lot of expertise in making certain things. We've done a lot of that domestically. We would like to help you, or we'd like to participate in building up the infrastructure, and that is partially because growing influence, of course, geopolitically, but also to get access to these consumer markets. Indonesia, for example, is a very large consumer market for them. It's a big country. I mean, maybe not compared to China and India in terms of population, but it is still a very big market. So it's a market they need to focus on. The internet companies there, but there's also these construction companies go there to build up these Belt and Road projects.
Right. Yeah. So also, I think, China is also trying to change or kind of reduce its dependence on the US as well, right? Like earlier, for instance, it was the biggest, I mean, it is the biggest importer of soybeans. It used to source them from US, but now they're sourcing them from Brazil. Like, again, Brazil has received a lot of BRI funding, and that's what I hear. So and even for the oil and gas, as well, like it's trying to kind of source more from Russia and other countries.
Absolutely. So there are, I think, 4 areas where China has identified where it has strategic weaknesses. And as I mentioned, if there is growing tension between the US and China, these are areas where the US could easily slow down growth in China. We've spoken about some of them already. So one of them is fuel. That is, they need access to the Middle East, oil, and they try to reduce that. And the EV movement is part of that. And of course, the renewables is part of that as well. Another one is food. When the chairman of Alibaba came, he was kind of underwater for some time and came back into the news. When he did so, he traveled to Europe and he went to 2 places. One got all the attention, was Ibiza, because people go there for having a good time. It's a nice place. The second place he went to is a place that all Dutch people know, but you probably never heard of it. It's called Wageningen. It's a small town in the center of the Netherlands. I don't know how many people live there, 20,000 or something. It's not a big town. But if you're in agriculture, you know this place because there is a university that is sort of the MIT in agricultural research is located there. So if you want food and you want to increase food production and want to have access to the latest technologies, that is where you want to be. And that's where he went to. So they're trying to build up food as well. So fuel, food, finance is a weakness. That's the debt problem I've spoken about. And lastly, of course, technology. And this is the biggest problem for them, that in particular now with growing AI, they need access to particular kind of chipsets and processing units. graphic cards, and the leading producers of those are kind of American/Taiwanese companies, such as NVIDIA, and access to that has been limited. And that is clearly for the US to try to limit the growth of China.
I think the US-China decoupling, which has been talked about since quite some time now, it seems to be happening, although slowly, but it seems that it has kind of started to take shape, right?
In this sense, that decoupling is taking shape. If you look at the numbers, actually, it's a little bit difficult still, because still a lot of trade between the two countries going on,
Yes.
and actually investments as well. But ultimately, geopolitically, you see that these two are trying to, be constructive with each other, but also separate. And if you go back in history and look at other periods where one power was rising and another power was existent. One book I read, for example, looked at England in the late 1800s and Germany. You see parallels. You see that there is eventually conflict between the two. They don't like each other, but on the other hand, they also have areas where they know they need to cooperate. Green technology, and the Americans need to buy solar components because, as we mentioned earlier on, the Chinese are very dominant in this. So there will be areas where they can cooperate, and other areas where they have a more antagonistic relationship.
Indeed, yes. So, Harold, if we now look at the China's economic activity, it has channels of transmission to the world, because obviously it's the second biggest economy. So now, how do you look at like it impacting the world with all these developments, even the short-term scenario or the long-term changes that are taking shape? How do you see them impacting the other countries?
Yeah, so there's a couple of kind of channels through which what is happening in China is being translated into what happens in the rest of the world, in particular in Asia. Yes, the first one is the investment channel, you could say, the fixed investment. So we see that companies are trying to diversify their assets. So the additional investment that they make, they try to make somewhere else. Tech companies going to India. We've seen investment going into Vietnam, and ASEAN countries and China have been very good in, not all of them, but most of them have been very good in saying, okay, we're good in this, so we're going to try to attract this. So, for example, Thailand always had an auto component business and said, okay, let's try to attract that. Malaysia always had semiconductor testing kind of industry that is now growing as well. Indonesia simply had nickel, and you need that for battery making. So the battery makers have gone there, and Indonesia therefore becomes part of the global EV supply chain. And India, well, it's just got a lot of people with pretty good education in technology and these sort of things. You can train them. So a lot of the tech companies have gone there, as you know very well, right? Actually, a lot of them to where you come from, Jolly, Gujarat and these sort of places, right?
Yes.
So these countries have said, okay, we can pick up. Actually, we can compete here with China in certain areas. Still, that doesn't mean that China gets hollowed out because it's such a big place. It just means that the companies that are in China need to adjust to that. So, okay, these companies go away, but we need to upgrade ourselves to remain competitive and move into higher end products and these sort of things.
Yes, indeed. And even from the import perspective, if we see like the construction sector itself accounted for a lot of $1 billion in imports from more than 60 countries. So even that sector, which is quite in problem and it's going to be for quite some time, is going to impact these countries, right?
Absolutely. And then you go into other channels. So you get channels like flows of capital and these sort of things. So and a particular unique thing there is that the flow of investments is moving into ASEAN and India. On the other hand, you also see that portfolio capital flows are changing. A lot of US investors have publicly stated that they're going to downweight China's position in their benchmark, so they're never going to buy as much as they used to do in the past, and therefore that is drying up a little bit. That's a negative. On the other hand, we see that Asian investors, in particular domestic investors, Middle East investors, Australian pension funds, and these sort of things, they're actually coming into these markets and offset that to a certain extent. So you see that there's a impact from what is going on, not just on investment flows, but also on portfolio investment flows.
Indeed. In fact, that is what I wanted to come to next. There are record outflows out of China. If you look at across asset classes, basically, I mean, September month alone saw a forex outflow of $75 billion. Like this is like not unseen levels in many years. Now, the authorities have kind of tried to implement numerous measures to support the stock markets and things like that, but uh, essentially the domestic investors as well as the foreign investors do not seem to be buying the dip. So do you think that this is a kind of a longer term stance? Like how do you look at this basically? Yeah.
Yeah, I think there are two or three things going on. First of all, because of the weaker economic growth that we spoke about earlier, there is a negative sentiment about buying stocks in China. People are worried about the growth outlook, and rightly so. If you look at these GDP numbers, they've come down, right? That is not completely correct. That's the second issue, because the earnings growth is different. As I said, we have the title of the book is Asian Stock Markets from the Ground Up. We have to look at these equity markets from the ground up. What companies are in there? What constitutes an equity market, and what sort of earnings are being generated? And what we find is actually that the earnings generated in a particular market very often doesn't have a lot to do with the broader economy. That is a bit the case at the moment in China. There is consolidation. There's companies that continue to do good. There are shifts in consumer spending taking place that we spoke on, related, for example, to aging and these sort of things. And some companies can therefore continue to grow quite well. So that's a second thing that goes on. But there's a third thing, and this is quite important. When we talk about Chinese and Chinese market and equity markets in particular, we very often talk about those companies listed in Hong Kong, because access to those in Shanghai is a little bit limited. Now, the ones in Hong Kong are mostly the larger internet names.
Okay.
And the larger internet names are a little bit still like almost you could say concept stocks. There's a lot of future growth that people see for those names. What that means is that they're very sensitive to, this becomes technical, but we're talking about the CFA society here. Think about it as DCFs. The cash flows go up, but the discount rate is also moving. And they're very sensitive to that because a lot of the cash flows are further into the future. And the discount rate for these stocks is the US bond yield. So the US bond yields moved higher. That's negative for all markets in the region, but in particular for these Chinese internet names. They really respond to this a lot. And that has also dragged these Chinese stocks down. So it's not just China sentiment, but also simply that they're very sensitive to what happens globally, in particular with US bond yields.
Indeed. I mean, this just reminds me that the US tech sector as such seems to be a unique case. It doesn't seem to be working that way for them. But of course, there's this whole new AI wave here. So, yeah.
Yeah, the AI wave has created some excitement, particularly in Korea and Taiwan markets, because they make what you initially need, which is computing power to stream a lot of data, you could say, into service, and they're making the service. And then later on, you need more chips that can take whatever is in the service and use that for particular purposes in AI. That's where the Taiwanese and Koreans are really good at. But yeah, China is of course doing so as well. Although it, as we mentioned earlier, it has problems accessing those chips because they're made in the US, and the US is trying to limit access to those particular AI chips, right?
Right. Okay, Harold, now I want to talk about the debt markets. And the high yield bonds market in Asia has been dominated by China with more than 50% of share, and majority of them were or have been property developers. Now, what are the lessons here for offshore institutional investors?
Well, I think the one lesson is that if the yields look really good, it doesn't mean that the underlying asset is really good. People could buy very high yielding assets, but then found out that these companies could pay 1 year, but later on need to restructure. The whole, and this comes back to what we started at the beginning, this is the property sector to a large extent. Those are the companies that dominate that particular market. They need to restructure that debt. So you need to be very careful if you go in that market, what kind of companies and sectors and subsectors you're going to invest in. And that the structure of that whole market will need to redevelop. China will still need that market. It will need an offshore debt market, a US dollar debt market that provides Chinese companies with access to US dollar borrowings. But it's been dominated by the property companies. As we said, they're just not doing very well. So that market is shrinking, and the composition of that market is shrinking as well. So that is part of the restructuring, and we'll probably find that new companies that will grow faster. Think about the solar, the wind, the hydro companies. Maybe some of the consumer companies will add in that market and say, "Listen, okay, I need US dollars to grow my business. So yes, give me the opportunity to borrow there." So the composition of that market will presumably change as well over time.
Interesting. So then it looks like they will also kind of try to improve their policies as well, because as of now, the sense is that the offshore investors have been kind of disadvantaged as compared to the domestic investors, and they'll have to.
Yeah. There are two markets. There's an offshore market. There's a domestic market. It's somewhat separated. That is correct. But I think as we'll go through the restructuring of a lot of that debt over the next couple of years, it's very important that not one party gets advantaged over the disadvantaged over another one, and that this is done in a proper way as these bonds were structured in the past. So we'll have to see how that's going to work out. But we're in the very early stages of this restructuring. So.
Yes, a lot remains to be seen on that front as well.
Absolutely.
But this market was entirely driven by China. Yeah.
Yeah, China is really big in that market. So that market is really, that market really struggles in that sense. Absolutely.
Indeed. Okay. So Harold, you've written a book on this, on Asia, and you've witnessed things quite closely. Is there anything that reminds you from what we are witnessing these days, like any anecdote from the past?
Yeah, and maybe a couple of lessons from the past. When I started my career as an analyst, I actually initially was for a Swiss bank, a small cap analyst in Indonesia. In those days, you still had small cap analysts in Indonesia. Indonesia was a big market at the time. Now, Indonesia went through a tremendous crisis. So we're talking about the debt crisis that we see in China at the moment and these sort of things. The Indonesian crisis was on certain measures probably about 3 or 4 times as big. And it led to massive political change. So we had a lot of companies, not a lot of companies, most companies in the market went bankrupt nearly within a period of 3-4 months. You had protests on the street. You had the president had to step down. There was a new president, a whole new election law was set. And Indonesia went through a reset. And looking back on it, that was a fantastic opportunity to invest in Indonesia. Together with India, Indonesia and India are the two markets that have really performed the best over the last 20 years or so. So Indonesia has gone through a complete reset. And while we're in the midst of a crisis and a market meltdown and bad sentiment on these markets, opportunities will arise, new sectors will arise and develop. And we should keep our eyes open for that we understand those opportunities as well. And I think that's been in Indonesia, but this is the case a bit in Chinese equities as well. There are good companies that will continue to do very well, and you can actually buy them now at very reasonable valuations.
Indeed.
But you have to be patient on it and sit on it. But I wouldn't be surprised that in the longer run we look back and say, hey, sentiment was really poor at that time. A lot of things were not going in the right direction for Chinese equities. The global bond yields, amongst others, didn't help out either. So actually, that was a good time to go for it. So that was probably a lesson learned. Indonesia was fairly dramatic. I mean, there were tanks on the street. I remember one evening of going back home, people were pelting rocks on the police and these sort of things. It became really almost dangerous to be there. And in those days you could buy. If I look back on it, you could buy good quality companies for literally for a dime almost.
Wow, interesting times. And before I let you go, Harold, I am curious to know which are those 7 languages that you know.
I wish I could say Hindi is one of them, but it is not. So I speak 7 languages. I'll quickly go through them, but I make the note that even my own native language, which is Dutch, I've lived in Asia for over 30 years now. I struggle sometimes probably with Dutch as well. Dutch, of course, would be one of them. English, I speak German, French. My French is pretty poor. I was fluent in Mandarin, but here in Hong Kong, I haven't spoken Mandarin for quite some time, so that's really a problem. I speak also Malay and Indonesian, and I can say Indonesian. I'm fluent to semi-fluent. I would say fluent in it. So that's something that I like. And then I speak a rather obscure language called Twents, which is spoken in northeastern part of Holland and northwestern part of northern Germany. And That's so that's it. But you probably speak a lot of language. You come from Gujarat, so you speak Gujarati. You speak Hindi. I suspect you, of course, you're English. So you're
Yeah.
already halfway there as well. I wouldn't be
Yes,
surprised
no.
you speak 7 as well.
I used to take pride in the fact that, oh, I know 3 languages, but which most of the Indians do. So yeah, you're right. Like one is the mother tongue and the other two are Hindi and English. But
Exactly.
this is very impressive stuff, Harold. And, thank you so much for sharing all the insights on the mysterious land of China. I look forward to having this conversation again with you.
Me
Thank
too.
you so much.
Fantastic. Thanks for having me on, Jolly. And let's do an update at some point in time. And
Indeed,
all
I
the
look
best.
forward to that. Thank you so much. Thank
Okay.
you to all the listeners of the CFA Society India podcast. Stay tuned for the next episode. Thank you.
Thank you.
Thank you for listening in to today's podcast. Before you go, please subscribe to stay updated on your favorite podcast app.